in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. The S&P 500 fighting to extend its record run. We're an hour away from the close on Wall Street, and markets are off earlier highs as we near the close. But we did get an upbeat reading on inflation, finally falling below 3%.
Plus, layoffs across corporate America, especially tech, piling up, and the stocks are rising to new highs. We're taking a deep dive into big tech as 5 of the Magnificent 7 stocks report earnings next week. We're going to get you prepared for everything you need to know ahead of those results.
And home sales bouncing back in December as mortgage rates edged lower. We're looking at the housing sector, especially home builders, as they gear up for earnings next week. Let's get you up to speed on the market action right now as we watch all 3 major averages try to hold on to those gains into the close here. We've seen a little bit of bouncing around here. The Nasdaq right now is in the red, off by about 0.25%. The S&P 500 barely higher here, but of course any gain again would be a record close for the index. And the Dow up about 72 points on the day, 71, 72 points. That's about 0.1% higher here. If we do see a gain in the S&P 500 today. That would be the 6th straight session that we have seen a record close for the index and a 7th straight day higher for it. In terms of what is propelling it higher in today's session, healthcare is actually the best performing group, followed by consumer discretionary. Information technology, though, is a drag due in part to a drop in shares of Intel, which we're going to talk more about later in the show.
We sure will. And we also have to talk about some economic data we got today. In fact, some interesting data we kind of just got this week. And I think in broad strokes, kind of this theme, Julie, where we keep seeing inflation cooling, but economic activity keeps humming. So the Fed's preferred inflation gauge, core PCE, so that excludes volatile food and energy costs, of course, we learned this morning, fell to 2.9% year over year. That is the lowest reading since March 2021. And this week we also learned U.S. GDP increased at a 3.3% seasonally and, of course, inflation-adjusted rate in Q4. So it certainly gives kind of ammunition to the soft landing camp. As rare and tricky as we know that is, the data, at least right now, seems to be confirming that. For investors, of course, you're kind of thinking through how you think the Fed thinks about that. But you would assume Jay Powell, Julie's looking at this data, he's feeling probably pretty good.
Yeah, and the economist reaction has been pretty good, and then some to this number. Krishna Guha, vice chair over at Evercore ISI, says that this adds to the steady accumulation of evidence that the Fed's job on inflation is mostly done. Chris Rupke over at Forward Bonds was gushing about the economic data that we've gotten recently. He said today was a double win for Fed policymakers, with inflation on target and real consumer spending keeping economic growth on track. He says there is no recession in the economy's future as far as consumers are concerned. Bet on it. So, you know, some really pretty strong words from economists.
Of course, we can rewind the tape and say how many times we're saying recession's coming.
Of course.
Bet on it, Julie. Yeah. I do think it's interesting. So what does the Fed do with this information? Because if you see inflation, it's moving in the direction that our central bankers, our policymakers want to see. Of course, they want to get back to that 2% target and then stick there. See, that's the issue. Is it sustainable? I mean, there are folks, we know Stephen Stanley, of course, the economist, smart guy. I always, when Stephen speaks, I listen. He continues to believe, listen, yes, it's going in the right direction, but he was telling his clients this morning, ultimately he thinks actually getting back to that target, that last mile we talk about, and actually sticking there, he thinks it might be tougher than many think. The Fed, in his words, has its work cut out for it.
Yeah, I mean, there's one more person I should mention who's weighing in on all of this today, and that's Janet Yellen, the Treasury Secretary, who knows a little something about leading the Fed as well. And she says it's not yet clear where interest rates are going to end up. So she is not, sounding the all clear or saying that there is victory on the interest rate front and the inflation front as of yet, which is a little bit different than what she has said in the past. She said weak inflation was going to return Now it's not as clear through what she's saying that it is. So we'll see how that works out. Well, now that Jerome Powell's most talked about piece of economic data has moved below 3%, are better days ahead for the fight against inflation. Our first guest today thinks that rates are still in the driver's seat when it comes to equity returns. George Cippolloni, Penn Mutual Asset Management Portfolio Manager, is joining us right now. Hey, George, good to see you. So what are you thinking at this point about whether the Fed has been successful and whether we are going to see inflation come back down and then it able to start to cut rates?
Hey, Julie and Josh, great to see you both. So I think the great thing for the Fed right now is that PCE has come back so much, and now there's a huge gap between the PCE and the Fed funds rate. And so we can equate that to a relief of pressure and really a lot of room for the Fed to start cutting, which is exactly what they wanted to see. And if we just think back where we were a few months ago, we had the 10-year at 5%, financial conditions were tightening, and there was a palpable sense of fear that we were going to go through 5%. Well, those days are over. And fortunately now with inflation pulling back, again, the Fed has room. I think there's about 125 basis points worth of cuts priced in for 2024. Coin flip, whether it's going to be March or May in terms of the start, but they are in a really, really good spot. And so far, so good for the Fed.
What about, George? I don't know if you heard, Julie and I, we were talking about this, and there are some economists, George, who are a bit skeptical. They like what they see in terms of the trajectory of inflation, George, but they're kind of saying, you know what, let's not break out the party balloons just yet, because that last mile, George, they think, to get really back to 2% and stick there, they think it might be a little tougher than maybe some expect. What do you think?
I think that's a fair point, because if you look at history, it hasn't just been down and done. It usually there are these bumps back up in inflation. And so I think that's what we have to watch out for. Obviously, once the Fed starts to cut, we tend to see the animal spirits get back into the markets. And we are seeing that, especially if you look at the PE of the S&P overall up 40% over the last few months. And so that's what you have to watch out for. I like to watch for mainly energy and oil prices. Gasoline's a big number that I tend to watch. And if you see a bump up there, then you might start to get worried about inflation working back in. But again, so far, so good. I do agree. I think that last mile is going to be a lot tougher than what we've had to overcome so far. And yeah, we'll see. I have a feeling we'll be range bound for Treasury yields for the rest of the year. That's what it feels like, at least at this point, off of 5, maybe a little higher than 4. And that's where we are right now.
And so what are the implications then for stocks also, George?
Sure. So lots of implications, obviously. I think one of the things, obviously, everybody looks at the big picture. They all look at the indexes. Underneath the indexes, underneath the big tech names, as we are all looking at in amazement, we're seeing a lot of weakness throughout. If you look at some small caps, even if you look at some big caps that reported some surprising results. So on an individual basis, you have to watch out for the 3Ms of the world and the Intels and even Humana that reported yesterday, Tesla. They were all down about 10%. We don't hear much about that because the broad indexes are still really strong. So, but I love divergences. As a bottom-up stock picker, I think that gives us a ton of opportunity to add value. Small caps look cheap. International ADRs look really cheap relative to the U.S. And so from my standpoint, I really like to see those types of divergences. From a broad stock market index, growth needs to come through. You mentioned the big tech names are going to report next week. They need to follow through with the growth that they have given us so far.
In terms of where you're seeing opportunity here, George, just in the domestic equity market, what looks attractive to you and what doesn't?
Yeah, so finally, in terms of income, we went through this period, that's the zero interest rate policy. There was no income to get almost anywhere. And it was really frustrating. I'm an income investor. We invest in the income universe at Penn Mutual. And so what's nice to see now is that there is some yield to get, and that's great. And another thing is, again, talking about the divergence, for example, utilities are trading at their lowest point relative to the S&P, maybe in history. They look really cheap. Some financials and banks, you're seeing some decent results, mixed results, I would say, overall in the financial sector, but you're starting to see some value there, and we have for the past 6 months. So I think, on a bottom-up basis, there's really some nice small caps, some nice ADRs that have just kind of been left in dust, but have some decent growth potential to them, which is good.
George, it has been a kind of a tough slog, though, not necessarily in income, but certainly in value versus
Oh, yeah.
growth, right? So,
Yes.
what's going to be the catalyst? You might be getting yield, but you're not getting that price return yet, right? So what do you think is going to be the catalyst? Is it going to be when rates start to turn more decidedly lower?
Yeah, it's a great point, Julie, because as a value investor, it feels like we get beat up almost every day. You see these 7 to 10 growths. I think in the S&P, 110 of the 124 increase in points was, a handful of the tech names that we all know so very well. So yeah, it's kind of been easy just to buy the index and just ride it. And value investors have basically been left in the dust. Again, underneath there in small caps, I do think if we do see this kind of steady state, this kind of turn off of inflation, I do think that'll be a good thing longer term for these names. I do think, again, there's only 3 ways the stock can go up. Either your PE multiple can go up, your sales can go up, or your margins can expand. And I think of those three set of factors, I think there's a much better combination of value left in small caps and in ADRs at this point. And I think we'll find those names and add some value there.
And George, I'll get you out of here on this. As we look across 2024, George, we started by talking about these kind of better economic data we're seeing. I'm just curious, George, what's the big worry for you in 2024? Is it the economy? Is it the Fed? Is it geopolitics, George? I'm looking at a headline here. Iran-backed Houthis say they attacked an oil tanker. What is your big concern as an investor?
Yeah, I think going back to a few months ago, if we start to see the 10-year go back to that 5% level, again, you really felt a constricted type of feeling almost in your chest when you're looking at the stock and the bond markets. And so given the high levels of debt that we have today, and just look at the government's balance sheet, as a great example, I think we're paying record levels of interest expense at the moment. So the market, the government, we all need interest rates to kind of settle in here and pull back and just stay at this level. I think the biggest fear would be if interest rates do go back up. And if they do go through 5, I think that's a problem. I think the market has proven that it really is going to have a hard time handling a 10-year through 5%. And I think that would be my biggest concern.
George, thank you so much for joining the show today, helping us kick off the show. We appreciate it. Have a great weekend.
Great. Thank you, Josh. Thank you, Julie.
Now, checking in on some of today's top trending tickers, check out shares of Intel. They are in the red as the chip makers' first quarter guidance came in below expectations. You could see Intel getting shelled in today's trade, Julie, down about 12%. By the way, that stock is now down about 30% since Pat Gelsinger took charge as CEO. So Q4 results beat, but the focus is on that guide. The Q1 forecast, which was weak relative to consensus. And just some puts and takes here to consider, the division that includes PC chips, that saw sales jump more than 30%, but the data center and AI segment, which is where Intel is really, looking to take on Nvidia, the big player, their sales dropped 10%.
Yeah, and just to put this in perspective again, as you talked about, yes, the stock is down since he took over again, but it is still up over the past year because hopes had been rising that he would be able to turn things around, that there would be a comeback for Intel, that it would be able to capitalize on the AI chip craze. So the shares are still up about 45% over the past year, even with today's decline, which is the largest single day drop for the stock going back to July of 2020. So now the question is this a fundamental hit to the optimism, or are we going to continue to see them recover in the coming months? The other measure that people were watching closely with Intel is its gross margin, which had regularly been around 60% if you look at a pre-2019 timeframe. In the first quarter, it's going to be 44.5%. And the company is trying to work back to that gross margin level where it was in the past. And obviously, it still has some ways to go there as it does these efforts to restart a foundry business and indeed capitalize on AI.
Yeah, we should mention, Intel's Pat Gelsinger was on Yahoo Finance this morning saying the stock reaction today is an overreaction, in his opinion. He was talking about the tailwinds as he sees them, the AI PC, the improving product line, told us the foundry business, so making chips for others, revenues will ramp in 2025 and beyond, but clearly investors, at least in today's trade, skeptical.
Yeah. One of the people we both followed closely, Stacy Rasgon over at Bernstein, his title of his note today, how many times can you push the reset button? Talking about investors getting fatigued here.
Stacy pointed out the great Intel reset story probably just shifted again, in his opinion, to 2026.
Right. All right, let's talk about another duo of stocks that we are watching. Payment companies going in opposite directions today. On the one hand, American Express in the green, up about 7%. It missed on the top and bottom lines here, but the company did forecast earnings that are ahead of estimates. And Visa, on the flip side here, despite an earnings beat, we're seeing some weak commentary from Wall Street analysts who are looking at a consumer slowdown potentially in January. Let's talk AXP quickly here. Part of the reason it missed last quarter, it said, was because of the Argentina currency devaluation. So that might be part of the reason why
they said, listen, if it hadn't been for that, they said we would have beat.
Right. So maybe that's a little bit of the reason that investors are looking past those more negative numbers and bidding up the stock. And then Visa, kind of the opposite situation there.
Yeah, and there were interesting comments from the American Express CEO talking to our own Brian Sozzi about the economy, saying, listen, I think it's slowing, he said, talking about the economy, and that's what's in our guidance, slightly lower economy, not a recession, he told Sozzi, but a slightly lower economy. And he was saying, listen, with our business model, we think we can perform even in that kind of environment, a slower growth economy. So sounding very confident there to Brian.
Yeah, it's interesting on the Visa side because it does look like that a lot of the analysts were relatively positive in the commentary around the stock. But to your point, there is some concern over January numbers and how spending there is going to look. And that there is a softish start to the second quarter, according to one analyst over at KeyBank.
Yeah, I thought it was interesting on Visa. Dan Dolev over at Mizuho, smart guy, we know him. Always one of those guys I pay attention to. Telling his clients on Visa, first quarter was strong, but he kind of did call out this softer than expected trends in January and higher OPEX guidance. So he's staying on neutral there. Yeah. And finally, let's check out shares of Spirit Airlines in the red as JetBlue could be walking away from their deal. An SEC filing, JetBlue states that certain conditions of the deal required for the closing may not be met in time. So this one you gotta follow the bouncing ball of this story. So Spirit really tanking here in today's trade. The news was JetBlue saying, okay, we might end this bid to buy the carrier. Of course, this comes after that judge blocked the deal, right? And JetBlue's now saying there are conditions to the deal that might not be met by the deadline in this agreement, and that could lead to termination, maybe as soon as this weekend, Julie. We don't know what terms exactly it sounds like they're being referred to here, but now Spirit then hitting back pretty hard and publicly, so war of words beginning here. Yeah,
and this is a change because both of them had been trying to fight the regulatory pressures on them to not get the deal done. Now they're turning on each other, and both of them have something to lose here. JetBlue will owe Spirit if the deal is blocked for antitrust reasons. But Spirit might owe JetBlue money also if the deal falls apart for other reasons. So, they obviously have something to lose because they'll have to pay each other, but they'll also have something to lose because they were hoping to get stronger by teaming up here. JetBlue was counting on getting those Spirit planes to try to increase its fleet. So it's definitely a messy situation.
I mean, Spirit at this point, you just kind of wonder what the options are because we've had financial analysts on our show who know the company really well, and they were talking about possible bankruptcy. So a story to keep
Frontier
watching.
was out there before as a buyer too, but maybe they're not willing to step back in now that they've seen what has gone on. All right, we're just getting started here on Yahoo Finance Live. Coming up, pending home sales jumping 8.3% in December. Could we be looking at a housing turnaround this year? And what's that going to mean for home builders? We'll tell you later in the hour. Plus, how will positive economic data affect President Joe Biden's approval rating? We'll check in on that, the latest Bidenomics on the other side, and the newest edition of our series, Goodbye or Goodbye. We'll get analyst insights, break down two stocks, and help you make the best choices for your portfolio. All that and more when we come back. Bitcoin soaring to close out the week. Jared Blickery here with a crypto watch for us today, but I suspect it's not making up for some of its recent declines.
A little bit, fractional. And let's take a look at the chart here in a second. Bitcoin up 5.41%. That's the best 24-hour period in weeks. And here is a 6-month chart. And this was looking a little bit toppy in here, and we did have a false breakdown. I'm calling it false now because we've had significant momentum to the upside from what could have been, or from what's looking like support that it was looking like it just broke. But if you're following the logic here, false breakdown, nothing new to Bitcoin, and we are seeing a run up. And we are seeing continuation and some movement in other Bitcoin-related cryptocurrencies here. Solana up 6.8%, but really Bitcoin unusually is one in the pole position today. Want to show you though, this year has not been about crypto, and in fact, Trax is the only non-stable coin in the green here. Lots of movement to the downside, and of course, if you take a look at the last year, it's a different picture. Solana up 283%. But let me show you the crypto-linked stocks as well, and I'll get back to an intraday basis. Crypto stocks really popping today, and you can see this in Galaxy, that's up 14%, Backed up 11, Marathon Digital, that's up 8.79. The list goes on, and a lot of these have just been underwater for the year. And here's a look at that. Now, PayPal, arguably, Bitcoin exposure is pretty low there. That's the only one in the green, and it's looking a lot worse for a lot of these other names there. So just kind of gaining some of that lost territory that we've seen. And also want to get an update of the ETF situation for Bitcoin. We have all these spot Bitcoin ETFs. By the way, this board has more than just Bitcoin ETFs. If you take a look in the upper left, BKCH actually has exposure to blockchain companies. So it's more linked to, I believe, crypto stocks, and that's why you're seeing that up a bit more. And then we're seeing some of these other ones tick to the downside. This is an inverse Bitcoin ETF, so that explains what we're seeing there. But all in all, a nice day for crypto.
Jared Blickery, thank you for that. Appreciate it. Now, with earnings season underway, we're checking in on how folks are feeling on Main Street. The answer, not great. Small business optimism came in below average in December for the 24th straight month. That's according to the National Federation of Independent Business. Here with more on what's weighing on America's small businesses, Holly Wade, NFIB Research Center Executive Director. Holly, it is great to have you on the show. Maybe just start there, Holly, kind of the 30,000-foot view. How are small business owners feeling right now? Can you kind of walk us through what you're seeing in the surveys?
Sure. So thanks for having me. And small business owners are fairly pessimistic still related to outlook on business conditions in the next 6 months and expansion opportunities. We've seen the same environment for about the last year and a half. And as you mentioned, our index that we have been collecting this data for 50 years now has been under the 50-year average of 98 for about 2 years now, and has been at recessionary levels, especially over the last year with the challenging environment that they're having to operate in with high inflation rates and still a tight labor market.
So when we talk about inflation, Holly, obviously we were talking about now inflation decelerating. But if you look at prices now versus where they were 3 years ago, they're still a lot higher than then. So is that why inflation is so much still on the minds of these folks? And how have they adjusted?
Absolutely. So we've seen in our survey that the first hit on inflation pressures are business owners' earnings. And so earnings have been deteriorating for a while now, and we've seen a bit of improvement on that end. So the first hit are business owners' earnings, and then they pass along those costs to their customers of their goods and services that they're selling. But that process takes a bit. They're also doing all of the things that you would expect internally in trying to increase productivity within their business, absorbing those costs in other ways. But when it's related to, the increased costs of their supplies and inventory, compensation costs, which are still a struggle for them in retaining current employees and attracting applicants for those open positions that we're still seeing at very high levels. And then also for some, that increase in financing costs has become quite troublesome for them in, again, absorbing those costs and figuring out a way to remain competitive and passing along those costs to their customers.
What about, Holly, jobs right now? What are small business owners doing? Are they hiring? Are they reducing headcount? What are the trends you're seeing?
We're still seeing very high levels, historically high levels of job openings in the small business sector. They are trying to hire and fill those positions where they're able to have applicants that meet kind of those minimum qualifications. They're certainly willing still to train in-house. That does take up a lot of resources among small business owners in training and skilling up some of the applicants that they're looking to fill those positions. So that's still very strong. It's frustrating for a lot of owners who have had trouble over the last, well, since the beginning of the pandemic in filling those positions. And this has been one of their main challenges. Still 1 in 5 small business owners are saying that it is their number one problem facing their business is the labor market.
And this is really interesting, Holly, because what we see, at least anecdotally, is a lot of large companies, large tech companies right now announcing layoffs. But it doesn't sound like that's what's happening on the small business side.
Not generally. I mean, the tech industry, they hired a whole bunch of people at the beginning of the pandemic. And so kind of right sizing and rebalancing their workforce makes sense. On the small business end, there was no, kind of that hoarding mentality that we kept hearing about with the large firms, in that they were trying to just keep as many employees on payroll. Payroll's very expensive, and they were having a hard time dealing with those increased costs. And so, they were trying to fill those positions throughout that time, and still are for many of them. It's been a struggle and continues to be a struggle, and very different situation than with some of their larger counterparts.
Holly, I'm interested when you all at NFIB get worried about a recession. Are there kind of certain tells or metrics you watch closely in your surveys for that?
Certainly. So we have questions related to sales, but those high levels of job openings, we would certainly see a larger fall off than we have to date. In that question, in that category of small business owners, more saying that, no, we don't have, we're closing that job opening, not interested in filling it. And the unfilled job openings are still at very high levels. And so we haven't seen anything related to kind of a deterioration of economic conditions in that way. It's just becoming still a challenging environment for them to operate with high inflation pressures and the labor market being so tight still.
Holly, really appreciate your perspective and to these small businesses. Thanks, and have a great weekend.
You too. Thank you.
As the latest inflation figures show signs of cooling, it is another piece of economic data making a positive print on Bidenomics. But given the prices are not expected to reach pre-pandemic levels, will it be enough to convince voters on a second Biden term? Our own Rick Newman's here and says 2024 will be the inflation election. Tell us why.
Hey guys, obviously inflation has been the biggest economic problem of Biden's presidency so far, and this is going to be very determinant in terms of who the next president is. So the election forecasts are starting to come in. There's a very interesting one recently from Oxford Economics, and they run their model, which they've been doing since the 1970s. It's been pretty accurate since then, and they say that the level of inflation in the fall, the third quarter of 2024, is going to be crucial. They think it'll be down to about 2.4% by then. But if it's a point higher or a point and a half higher, that could be determinant. Biden has a pretty good chance of winning if inflation is at their target of around 2.4%. But their model says if it ticks back up to around 4%, Biden loses. And then they also highlight how important it is how voters are thinking about inflation. And there are different ways voters do think about inflation. We've seen this in confidence numbers. If voters are just focused on prices have gone up and stayed there, that is bad for Biden, and Trump could flip a couple of those really important swing states, and that might be enough to make a difference. On the other hand, if people start to relax about prices and they are just paying attention to the inflation rate itself, which is kind of how economists are thinking about it these days, that's good for Biden because the rate itself will probably be in the 2s, which ordinarily would be kind of a nothing burger. So there's a lot going on in this election. It's a more complex election than we have certainly had in modern times. But if you're going to watch one economic indicator for sure, it is inflation.
Let me ask you, Rick, do you think it really is going to be the inflation election? Because I've seen at least some polling, Rick, showing that maybe now actually it's immigration that is edging out inflation as the top policy concern now.
Yeah, immigration certainly has become a bigger issue for all voters than it has before. I mean, immigration is an issue that for the last, let's say, 10 or 15 years, and we're talking about illegal immigration here, really, not legal immigration, all the migrants coming across the southwest border. This is something that Republicans have cared a lot about, but independents, who are the really important swing voters in about 6 or 7 swing states, they haven't worried about it so much, but clearly it is on more people's minds. And the reason this is a big deal this year is that this is Biden's weakest issue. So in just about all the polls, when you say, how do you rate Biden on healthcare, on abortion, on the economy, on immigration, he normally comes in worst on immigration. And this is starting to hurt him among swing voters. So, there's this deal underway in Congress. We don't know if it's going to happen or not. To do something about the southwest border and pair that with more aid for Ukraine and Israel. So Republicans want to be tough on the border, but now it looks like Republicans are going to back away from that deal, and we're going to get no action on the border unless Biden changes his own policy by executive order. So this ought to be on Biden's mind, but it's kind of perplexing because he has not really indicated he's aware this is a problem for him. So, Josh, you are right. Definitely something to watch for the next 10 months. I still think it's going to come down to inflation, but we'll have this conversation 10 months from now and see if I'm right.
Rick, always love having you on the show. Have a great weekend, my buddy.
You guys.
Coming up, it's the newest edition of our series, Goodbye or Goodbye. We put 2 stocks head to head and get analyst insight to help you make the best choices for your portfolio. Stay tuned. More Yahoo Finance after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. So far this year, industrials are lagging behind the broader market index after delivering positive returns in 2023. Is now the time to buy into the sector? And what's the best way to play it? I'm here with Brian Mulberry, Zacks Investment Management Client Portfolio Manager. And let's dive right into it. It depends on where, I guess, is the short answer here. But let's talk about your buy here, and that is 3M. Interesting timing here because the company did just report and the stock reaction was not fantastic, but you see some reasons for optimism here. Let's start with supply chains.
Yeah, absolutely. So after the earnings yesterday, what we saw is a little bit softer guidance coming out from the management team, and that's had pressure on the stock so far. But what we like long term is 3M has improved its supply chains to the point where they may save as much as 38% on margins, and over a long period of time, that gets added back into the balance sheet. So the lower cost of materials in doing business is adding to profitability. And so we see organic growth over the next 3 years, much better than what they've seen over the last 3 years. So this is going to add back, I think, a lot of value to the price per share.
And let's talk about the cash flow, too, because that's something else that you're looking at here combined with that margin story.
With that strong cash flow position, 3M has been very shareholder friendly over the last several years. They've actually added back significantly to the dividend, and they're buying back shares as well. So they're doing something, I think, very productive with that strong free cash flow position. So now you've got a dividend yield north of 5% on a company that has a PE under 10. So in terms of putting, productive capital to work, this is a really good valuation.
Yeah, and they just, as you said, boosted the dividend again. So what did you say the yield was?
A little over 5% now. They added back $1 per share to that dividend over last year, again, showing really strong free cash flow management coming off the balance sheet.
And presumably, if rates start to go down, that becomes even more attractive.
Absolutely. So it's one of those few stocks that's out there that's actually equaling what you're getting at a money market account right now. 5% yield is important. If I'm only getting 3 or 3.5, that's not as attractive as I'm still getting a really good risk-free rate in savings. But now, again, a really strong multiple in terms of earnings growth and a good, strong dividend yield at the same time. Again, productive capital long-term as an investment. That's why we like this name so much.
So we like to ask people what could go wrong, right? What's the sort of bear thing that could happen here? Weakening mask demand, which we've already been seeing here, and then something happening on the expense side as well.
Of the 4 business units that 3M manages, healthcare is definitely the weakest and has the weakest outlook. And that's just a year-over-year comparison when you consider the fact that we don't have that strong of mask demand for the obvious reason that we don't have shutdowns and mandates and things of that nature. But one of the great things about 3M is the management team has identified this weakness, and they're going to spin off the healthcare segment into its own standalone company later this year.
Gotcha. And then possibly if there is an increase in commodity prices, that could be problematic for them as well?
Sure, absolutely. But again, we have kind of a little bit of a yin and yang there. If rates do come down, it will offset the strength of the dollar. That could help actually be a little bit more of a tailwind than a headwind. But again, the balance between all of that and the strong bottom line margins with all of these effects in place is why we like the stock long term.
And just to be clear here, you guys have got a pretty big, you're implying a pretty big gain from here. 220 is your price target. You're looking pretty long term. I'm not used to seeing a 3-year price target from people.
Sure, absolutely. And that's one of the biggest things about us at Zacks is that we're long-term investors. We're not short-term traders. And the price action this week shows that. What we're seeing here in our price target is the effect of that organic sales growth. There's a swing of 5% in organic sales growth because of those cost savings. That gets piled back into the balance sheet, and that's why we see there will be more interest and upward price pressure over the long term on this stock.
Okay, and just quickly, do you own this stock?
We do own this stock.
Okay, gotcha. Now let's get to your goodbye, the one that you don't like. In the same industry, we're looking at RTX, another industrial that just reported as well. It had a better reaction, but let's talk through why you don't like this one. First up, FX headwinds.
Yeah, absolutely. And so what we know about Raytheon, because we used to own this, and we actually said goodbye to it in our portfolio recently as well, mainly because a big part of their private business is making aircraft engines for Airbus. That means they have a European client that's priced in euros, and with a strong dollar, that's adding to pressure on their profitability long term. Now, we do believe that Raytheon is a good company. They get 60% of their revenues from government contracts. They're not going anywhere, but we're talking about valuations today, a PE of around 18 and only a yield of around 2.5. So how is your capital being treated? not nearly as well as it would from a company like 3M.
And let's also talk about perhaps their debt burden and the effect. Yes, rates might be moderating a little bit, but they're still higher than they've been for the past few years.
Yeah, absolutely. And that is showing, and we're starting to see that weigh on a lot of balance sheets as some of that debt has to get refinanced as it rolls over. Even as rates are expected to come down, we haven't seen it materialize yet. And so that cost of capital is rolling off the balance sheet, squeezing their bottom line margins as well.
And then finally, Chinese sanctions hurting a lot of different kinds of businesses, including, let's go back just one here, sanctions on Taiwan. So that means a market that maybe could be open to RTX is not going to be as open.
Exactly. And so it's one of those things that, again, further weakens the balance sheet position and over the long term doesn't provide as much return of capital to shareholders, which is why we think there's going to be a little bit softer reaction. Still probably largely positive over a long period of time. But in terms of the growth rate over 3 years, we simply don't see RTX catching up to a company like 3M.
Okay, what could go right here in this case? Aerospace could just generally improve?
Absolutely. So we know that air travel has come back and beyond what pre-COVID levels are. With those conditions underlying, we know that there's going to be huge demand for new equipment, especially wide body equipment, and we're seeing overseas travel pick up enormously as well. The Pratt & Whitney segment of Raytheon supplies great big engines to those airliners, and we would expect that if demand were to continue at these levels, that we would see production ramp up. That is one of the most profitable segments of their business. So if we are wrong and we see that pick up, that's what would be a major tailwind for Raytheon.
Gotcha. All right, so let's sum up here. And by the way, the 3-year price target there is 140, which is, you know, doesn't imply upside.
Relative growth of around, 30% versus perhaps a doubling of 3M in that same 3-year period of time. Again, just why you would want to own it as a long-term investment, not a short-term trade.
It's all relative. So let's sum up your position on these two. You're telling investors to buy 3M based on supply chain improvements, solid free cash flow, and that boosted dividend. On the other side, you say maybe avoid RTX right now because of those foreign exchange headwinds and high interest rates weighing on the company's balance sheet. Thanks so much. Really appreciate it, Brian.
Thank you.
Thanks for coming in. All right, that does it for Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. U.S. pending home sales jumped 8.3% in December from the previous month, far outpacing Wall Street's expectations. December's uptick was the largest since June 2020, though the National Association of Realtors Index remains far below pre-pandemic levels. Joining us now with what is behind this jump is our Danny Romero. Rates? Is it about rates or is there more going on here?
It is all about rates. It's about those mortgage rates, and mortgage rates are below 7%. So that's really fueling people to get back into the market. Pending home sales, remember, is a really great early indicator to assess the housing market's health. So December's sales really showed an uptick in demand. Remember, mortgage rates were actually above 7% in the first week of December. So that really does signal that buyers are not steering away from this despite these elevated rates. But another factor that's really helping this market is there's more active listings into the market. And so Realtor.com actually reported that there's a 9% increase in inventory. So that's also boosting some of these sales. And on top of that, there is confidence from economists that home sales will increase this year, which will be dependent on inventory and, of course, mortgage rates.
And Danny, get you out of here on this. How did sort of new versus old housing sales shake out in 2023?
Last year, it was all about the new home market. It was the bright spot in the housing market. It surprised consumers. Wall Street was completely wrong about the new home market. They did not expect home builders to really fill in that void. They also, obviously, the builders were offering incentives like those mortgage rate buy downs, which really fueled a lot of demand to look into that market. But the big issue between the resale and the new home market is that the resale market is still a bigger footprint and higher prices as well. New homes is a little bit more affordable and a smaller footprint in the housing market. So that'll be kind of, we'll have to wait and see really what happens with these home builders, whether or not they will continue offering these incentives, because that's really the demand, the driver for so many people going into the new home market.
All right, big important story. We'll keep watching. Thank you, Danny. Appreciate it. Home builders have been enjoying a strong run, but our next guest is feeling cautious about home builder stocks going into 2024, leaving investors wondering if the rally is finally over. For more on the home builder landscape in 2024, we're talking to Jay McCandless, Wedbush Securities housing analyst. Jay, it is good to see you. So I'm looking, Jay, at the XHB, the home builders ETF. It's basically flat so far this year, Jay, but listen, it's still up more than 40% over the last 12 months, but you're broadly feeling kind of cautious, Jay, about this sector. How come?
Yeah, good afternoon. Thanks for having me on. I think you said it, the big run that we had in these stocks, especially with the move that we saw in December, felt like we priced in a lot of good news. Also, we have the house view that mortgage rates probably stay where they are for an extended period. You look at D.R. Horton's earnings release earlier this week. They talked about having still heavy use of incentives. Their gross margins were weaker than we expected as a result of that. So in an environment where the builders are having to do a lot of giveaways and mortgage rate buy downs, we just feel like at these levels, most of these names have priced in this good news.
Jay, talk us through supply and what you expect there in 2024. You know, how much are these guys going to be able to continue to build to meet the demand that there is out there?
Yeah, so nationally, the National Association of Realtors numbers that came out for December showed inventories of existing homes were only about 1 million in the U.S. right now. That's near the lows that we saw during the thick of COVID. You know, if we're right and mortgage rates kind of hang around this 7% level, probably don't see a lot of supply come on. That could work in the builders' favor, especially as they've been trying to bring prices down, in addition to rate buy downs, coming out with smaller footprints, more affordable footprints that could help new homes continue to take market share from existing, like they did in 2023.
I'm interested, Jay. You know, the Fed is expected to cut rates this year, and you know, I would think, Jay, that's a pretty great bullish tailwind for this sector, just in terms of lifting sales and margins. You know, builders can reduce the incentives. So is your point just simply, okay, that's a tailwind, but it's just simply priced in at these levels?
Yeah, I think that's part of it. I think the other side of it is that even though there is the potential for rate cuts out there, in terms of the actual effect on the 30-year mortgage rate, the 30-year mortgage rate has only come down as of where the numbers are today, only about 100 bips. So homes are slightly more affordable than they were, but much more expensive than they were, say, a year ago or even 2 years ago. And we feel like with, again, the move this group has had, we've priced in a lot of that good news. And if we do see, and I think probably the risk to our more cautious view is that if mortgage rates do finally start to come down at some point, that will pull more people back in, potentially can make our numbers be a little conservative. But right now with mortgage rates kind of stuck at 7%, just don't see a reason to get overly bullish on the space at this point.
That said, there are some names that you like within home builders, and one of them is one that I wasn't as familiar with, and as you point out, it's not as popular. It's a company called Cavco that does factory-made housing. Why is that one more attractive?
So Cavco is a name that sells affordably priced homes. According to the Manufactured Housing Institute, the average price of a single section home was $70,000 last year, in 22, and $210,000 for a double section home. You compare that to where existing home prices are on a median basis at almost $330,000 in the U.S. This Cavco is a name that sells a very affordable payment, which is what the manufactured housing buyer is typically looking for. We also think the balance sheet of this company, which is all a net cash balance sheet, significantly net cash balance sheet, gives them the staying power to weather some of the mortgage rate fluctuations that the manufactured housing market saw in 23, just like the site-built housing market saw.
I'm interested, Jay, when you look at these home builders, just as companies, have they become more efficient, Jay, in the last few years? Do their business models look different?
Yeah, I think so, and especially if you think about the enhancements that they've made to their websites. 85% of home searches start online now, and the builders, even before COVID, but especially as COVID took off, the builders made a lot of enhancements to their website. You can plan out a lot more things. You can get a visualization of what your home might look like on a given lot inside of a subdivision. So I think for the Gen Zs and the millennials who are solidly in household formation years, having those tools for digitally native buyers, I think it's been a great resource. I think the other part of it is the industry in general is finding ways to take lumber out of the houses and maybe take some of the build time out of the houses through engineered wood and other products like that. So making the house stronger and a little faster to build. So yeah, these are much more efficient companies from that perspective. I would also say that the balance sheets of the majority of the names we cover are in much better shape than they were 5 years and especially 10 years ago. So building the houses a little smarter, as well as running it more efficient and less debt on the balance sheets.
Jay, thanks so much for joining us today. Really appreciate you helping us kind of think through this sector. Have a great weekend.
You too. Thanks.
Coming up, closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
have the closing bell on Wall Street. So let's check on the markets here. It looks like are not going to continue the S&P 500's record streak here. It had been setting records for 5 straight sessions, was going for a 6th, not quite going to make it unless something turns around as the trades settle out. Right now, off by 3 points as everything is said and done here. The Dow closing higher by about 60 points here. The Nasdaq lower by about 0.4%. Even though the S&P 500 not making it to another record today, it is higher for the 3rd straight week in a row. And in fact, as I glance at it here, 12, it looks like 12 of the last 13 weeks for the S&P 500 have been winning weeks. So we have seen quite a streak on that front there for the major averages. A lot of it, of course, has been driven by what's been going on in the tech sector, even as we await some of the big tech earnings.
Big tech earnings.
Yeah.
Should we talk about some trending tickers?
Let's do that.
Would that be nice?
Yes,
All right, let's get to that.
That would be nice.
Tesla recalling nearly 200,000 cars. That's due to a software instability issue, closing out what's been a roller coaster week for the company. JP Morgan, by the way, also slashing its price target on that stock after the automaker reported softer than expected earnings for the 6th straight quarter. So this one, Julie, we did hear from Dan Ives over at Wedbush today. Interesting note. Now, Mr. Ives, still bullish, outperformed targets 315, but he was, in his words, massively disappointed with that with that conference call. Here's what he told his clients this morning. Here is what Musk needs to do. You want to hear what Dan Ives
Yes,
has to say? Here it is.
yes.
One, he says, let's get some capital return going. You got to announce a $10 billion buyback. He says gives Musk more control. Remember, there's this drama playing out. Musk says, listen, I want control, or I might just take my AI and robotics projects, Julie. I might take them someplace else. I will pick up these marbles and I will go to a different game. And stop the price cuts, he says. Maintain margin leverage over all the other auto players. So that was the Dan Ives playbook for Mr. Musk.
Well, if Musk listened to Ives or anyone except the voices in his head, that would be a first. So we'll see if he does make any of these changes here. Just a couple superlatives for you as we look at the Tesla performance on the week here. Tesla on track for its worst week since the one that ended October 20th, which incidentally, it also reported earnings. So in other words, it fell after that last earnings report, fell after this earnings report. It's now down 26.5% year to date or so, at the lowest price since May. And it looks like we are now looking at the 6th straight weekly decline for those Tesla shares. There's a lot of discussion here about how long these doldrums for Tesla might last, or whether the stock is nearing a bottom now and then could reset. I think time will tell. We do know that after the close yesterday, we learned that Cathie Wood's ARK had come in and bought some Tesla here. In fact, almost 178,000 shares of Tesla. Last year, we saw her kind of get in and out of the stock a little bit, not out entirely, but add and subtract a little bit from Tesla. So, we'll see if some other bulls who are devoted end up getting in.
It's just, after that print and after that call, you just had so much uncertainty still.
Yeah.
One is just kind of big picture uncertainty. Where is EV demand exactly? It's certainly slowing here, and the price cuts that Dan Ives is talking about, and the margin trajectory, and then of course competition. With Chinese rivals, the BYDs of the world.
Yeah, a lot of questions remain. Let's get to another mover on the day. Health services provider BrightSpring, which went public today, the company opening below its $13 offer price, and it didn't get back up there. So the shares finishing lower by 15%. The company raising almost $693 million in that IPO, but it did price the shares at below the expected range. It is backed by KKR, by the way. So everybody's looking at the IPO market this year. We've been talking to guests about it. They're hoping that things are going to open back up. This is not a very good omen.
No, it's fun. You're right. So this biggest kind of conversations kind of had this trickle last fall, the ARM, right, and Instacarts. We actually remember just this week we talked to John Keaton over at Torch Capital. We asked John, do you think it's is the trickle going to turn into a stream? He was like, no, it's going to be a trickle.
Yeah.
At least the first half, in part because he said, just too much uncertainty still and questions about the economy. And in part it was interesting, he said, because the reception that these folks are getting has not been encouraging.
Right, and this is not like a buzzy tech startup, right? This is a community-based health provider backed by KKR. Right. So it's not like that this one had the most hype surrounding it. But still, folks who are looking for that IPO market opening cannot be too overjoyed with this kind of result.
Sure. All right, fine. Let's take a look at Colgate-Palmolive shares. They're rising after being on the top and bottom line. Nice pop in today's trade. Company expecting organic sales growth to be within its long-term targeted range of 3% to 5%. So let's talk household products, Julie, just for a hot second.
Let's do it.
The stock did hit a 52-week high in today's trade. And just kind of looking at the results, it was interesting. The Q4 adjusted earnings beat. It looks like sales clocked in at $4.95 billion. That was also a beat. It looks like the Latin America division, that was one real standout in the print. Stocks up about 10% now over the past 12 months.
Yeah, oral care also doing well. The classic toothpaste stuff that Colgate-Palmolive makes. I mean, a lot of the commentary I'm seeing around the earnings is like, okay, this was good. It was, it wasn't fantastic. One analyst at Wells Fargo said it checked the boxes, the numbers, right? So it's not like an enormous amount of enthusiasm here, but just nothing that really raised alarm bells. The company for the full year says organic sales growth is going to be 3 to 5%, which leaves it a little bit of room potentially to beat analyst estimates.
Yeah, team at Evercore. Now they do like this name. Their client, their price target's 90. They like what they say is a high quality beat, meaning EPS and margins beat despite kind of the reinvestment in advertising. They call that oral care, Latin America, and North America, where volume stabilized, Julie.
Yeah, that's what analysts investors want to see right now. Volumes looking better.
For sure. All right, we move on. Intel dragging on the tech sector after its first quarter outlook came in short of Wall Street expectations. However, the major averages locking in a winning week as Meta and Microsoft reach market value milestones. And then next week, we're going to be make or break for the tech sector with 5 of the Magnificent Seven reporting earnings next week. Angelo Zeno, CFRA Research Senior Equity Analyst, joining us now to discuss more. Angelo, it's good to see you. Maybe I would love to just get your take, Angelo, first on Intel. Obviously got hammered in today's trade. We were talking earlier, it's down now about 30%, Angelo, since when Mr. Gelsinger came in as CEO. I'm interested to get your thoughts, your reaction to that print, Angelo.
Yeah, no, absolutely. So, definitely the disappointment was obviously on the guidance side of things, and Intel really kind of blames everything except what the real problem is at the company, right? They kind of blamed greater than expected seasonality. They blamed Mobileye, their programmable solutions group, among other things. But the real problem at Intel right now continues to be on the data center and AI side of things. And the fact of the matter is they don't have the right solutions out there to compete with the Nvidias, AMDs of the world right now. And they continue to lose significant wallet share within the data center space, which used to be their bread and butter area. So that's really been the big problem here. We think a big problem here in terms of kind of the 2024 outlook. And that's really, I think, what is frustrating investors right now. It's not something that's going to save them here over the next 3 to 6 months. They've got a new GPU coming out in 2025. There is potential here over the next couple of years. Foundry really kind of the real growth opportunity for Intel. But again, that's a longer term opportunity. If you're an investor in this stock right now, you're paying about 19 times on a 20 to 25 basis for a company that's still burning cash and really isn't going to kind of meet some of those ambitious opportunities for a couple of years. So that's the problem right now, we think, for Intel.
Yeah, and Angelo, it's Julie here. So it sounds like you don't think that enterprise spending, for example, is the problem. It's idiosyncratic to Intel. So I want to talk about next week when we are getting some heavy hitters in large cap tech. So of your coverage universe, and the biggest of the tech companies, when we're talking about an Alphabet or a Meta or a Microsoft, where do you think, who has the most to lose in earnings? Who has the most riding on the numbers that we're going to get next week?
So, in my opinion, the one that's got the most riding on earnings is probably Alphabet. So in terms of Alphabet, if you recall, after Q3 earnings season, that was the name that actually got hit the most. I think they were hit about 10% on the numbers. They actually beat the numbers on both the top and the bottom line. And the digital ad space we think right now is kind of running on all cylinders. Both Meta and Alphabet should do very well on the digital ad side of things. But the problem here for Alphabet is we saw the cloud numbers really decelerate on their Q3 numbers, right? It decelerated from 22% or to 22% in Q3 from 28% in Q2, while we actually saw a stabilization and acceleration in certain instances in terms of Microsoft and Amazon. So if we see some sort of disappointment, another leg down in terms of the growth number for Alphabet here on the Q4 results, I think that points to kind of, further disappointment and kind of downside to the shares for Alphabet. So that's if I were to, pin kind of, one big unknown out there, to me, it would be Alphabet.
And Angela, I want to get your take on another big name reporting next week, and that's Apple. We had tech investor Dan Niles on the show this week, Angelo. Not a fan of the iPhone maker. And I think Dan's point was basically, the argument he made to us, Angelo, is why am I going to pay about 30 times for this company where the top line performance is this underwhelming? That seemed to be his core argument. What do you think, Angelo?
Yeah, I mean, listen, the reason you're paying high 20s on a 2025 basis for Apple is because of that free cash flow potential, right? I mean, this is a company that we think this year is going to generate about $110 billion in free cash flow, the best free cash flow generator out there on the planet, clearly supporting the buybacks and real stability in that overall business. So, when we kind of think about here the December quarter results, the two key factors you have to look out for is one, the services business. That continues to be the main growth driver for this company. You don't necessarily need to see top line growth or significant top line growth to see the earnings growth for Apple. If you actually kind of look in calendar 2023, you're probably looking at about 8% earnings growth on no revenue growth, right? And that's because of that ongoing mix shift towards the services side of things, which essentially has 2x the margins that hardware does. So we need to continue to see good growth on the services side. And then China is, of course, going to be the other big story out there. If they're showing that China is holding up very well, I think that's something that kind of alleviates some concerns out there for investors and potentially kind of allows the stock to continue to work here over the next couple of months.
What about, Angela, how much focus are you going to have about what they have to say about the kind of non-iPhone hardware in the quarter, watch, iPad, Mac?
Yeah, I mean, listen, I think as far as those businesses are concerned, the only one that probably will show growth is Max because some of the new products that they rolled out in the easy comps from a year ago. You're probably going to see some sharp declines, specifically on the iPad side of things. They didn't have any new products on that side. And then on the wearable side of things, it really is kind of what they have to say about the Vision Pro. And that has the potential to kind of move a couple of basis points on the wearable side of things here over the next couple of quarters. But we're not expecting much on that side of things. So, I'm not looking too much into those type of end markets right now, but something to definitely keep an eye on.
And how about Meta, which just made up all of its pre-pandemic losses, right? So, it seems like maybe there's some pretty good expectations baked in there.
Yeah, I mean, listen, as far as Meta is concerned, I mean, if you look at the two best performers since the market lows in October, in terms of the Mag 7, it's of course been Nvidia, and the other kind of big outperformer has been Meta. And a big reason for that is the valuation. And the valuation to us is still somewhat enticing. We're talking about kind of 19, 20 times on a calendar 25 basis, but on a net cash basis, even more attractive, about 18 and a half times. So our view here is the numbers are going to look very good. It should be another kind of beat and raise quarter, given what we've seen out of the digital ad space here. All eyes, I think, are really going to be on what they have to say on AI and how it's improving their kind of ecosystem, but also in terms of China. When you think about companies like Shein and Temu, they're spending a lot more on Meta's ecosystem as they look to kind of aggressively, advertise outside of China because of the slowing market over there. So within the U.S., emerging markets like Brazil, we think is going to be a big theme for Meta in 2024. We think they're going to continue to kind of show those beats and raises in the first half of this year, again, off of some easy comps. And in the second half of the year, you do have kind of a huge election going on, right? So if there are investors out there looking to kind of play the election here, that is potentially a way to do it via Meta.
So finally, while we got you, I want to ask about Microsoft also, just round them all up, right? You mentioned AI, of course, as a factor for Meta. Is AI the factor for Microsoft? Do you think investors are even going to pay attention to the rest of the business, which is still most of the business? And do you think Microsoft is going to have to show some profitability tied to AI?
So when we think about Microsoft, really there are going to be three key secular growth drivers to this company, right? The cloud is one, AI is the other, and then gaming is the other with that recent acquisition of Activision. And we think all three areas are going to show, very good prospects here for the December quarter. On the cloud side of things, they pointed towards some deceleration here for the December quarter from the September quarter. Still very healthy, 27 to 28%. If we see a number above that with greater contribution from AI, AI was about 3 percentage points of contribution to cloud growth in the September quarter. If we get something closer to 4 to 5 percentage points, and again, a beat on the cloud side of things, we think that's where the upside potential is and where some excitement grows for Microsoft. And then, of course, what they have to say about Copilot 365, that just launched in November. We think they're going to be very excited about it, but the trajectory of Copilot, of course, is going to be a kind of a huge kind of area of interest out there for investors. So that's what we would be looking at for Microsoft. It is our top play in terms of it being a strong buy, and 12-month target price is $420.
Angelo, it's going to be a busy week. I can't wait. Thanks.
Get lots of rest this weekend.
Thank you for joining us, Angelo.
All right, thanks for having me.
Still to come on Yahoo Finance, over 23,000 tech workers have been laid off already in 2024. We're going to break down what this means for next week's jobs data later in the show. Stick around. More Yahoo Finance next. The S&P 500 snapping its record run here, but it was still a winning week. Yahoo Finance's Jared Blickery is here with the recap. Jared.
Dow record, that counts, right? Well,
Yeah.
we also have some green for the day, but importantly, the major indices are in the green for the week, and this is now 12 out of the last 13 weeks. Just an incredible bull run here. And let's take a look at some of the individual stocks contributing to this list of record highs. We have a new entrant, American Express, up 7% today off of earnings. Haven't seen that on the record high list for nearly 2 years. You have to go back to February of 2022. Also, Berkshire Hathaway, a recent entry, that's up 1%. Meta, Alphabet, you know the list here. TJX and Ross Stores, so some retail names in there. Hilton, you got travel. Aflac, you got insurance. Boston Scientific, you got pharmaceuticals. So a broad swath here that we're looking at. And let's take a look at the sector action for today and also for the week. Energy, the big winner on both fronts. That's up 0.75%. We are actually just seeing some headlines roll in from the Middle East where there was a missile apparently fired at a vessel and it is now on fire near Yemen. We're going to talk about that with an oil guest shortly. But for the week, let's check out the 5-day totals. We haven't seen XLE with a gain like this in 1 week in quite some time. It's been a laggard recently, so that's significant. Communication services, that's up 3.8%. That's Alphabet, Meta. Netflix was a big component of that gain this week. XLF is financials. All three of those outperforming. To the downside, consumer discretionary down 1.8%. That is a Tesla story. We're going to see that in a second. Real estate and healthcare also in the green. And here's a look at the Nasdaq 100. We do see Tesla. Well, that is a standout there. That's down 13.6%. Worst week in a long time. Intel also the worst week since last year, but some decent gains by the mega caps in the Mag 7. Once again, Alphabet up 4%, Amazon up 2.4%. So another week of records.
Another week of records. Again, defying predictions, Jared. Thanks a lot.
Defying predictions, yes.
Salesforce, the latest tech giant to join the list of companies announcing layoffs this year. More than 23,000 tech workers have been laid off thus far in 2024. It's the most since March of 2023. That according to data from layoffs.fyi. Here with what, if anything, this signals for the labor market. We're welcoming in Betsy Stevenson, professor of public policy and economics at the University of Michigan. Betsy, it's great to see you. As we try to sort of decipher where the labor market is now and where it's going, how should we read these public layoff announcements when we're trying to extrapolate what's going on under the surface?
You know, I think it's incredibly difficult to look at a single company or even a handful of companies' layoff notices and draw conclusions about the broader economy. Let's step back and put it in perspective. Every single week, in a booming economy like we've had, roughly 200,000 people lose their job and are able to file for the very first time for unemployment insurance. So the numbers you're talking about are still small and relative to that 200,000. To give you another way to put it in perspective, every month, about 1.5 million people are laid off in the U.S. economy when the U.S. economy is doing well. So in a normal economy, we have a lot of movement. And in fact, that's actually one of the strengths of the US economy, that there are people who get new jobs, there's new opportunities. You know, there's 8 million jobs open right now. So there's a lot of opportunities out there. And then when things aren't working out, when you realize you have too many people, when whatever business you have tried to expand into, it's just not going as well, you cut back. And that's certainly hard on individual people. And I have, like anyone, empathy for the people who've actually got those pink slips, who lose their job. But it is very difficult to say that this is some kind of warning sign for the economy. In order for us to conclude there's a warning sign, I think we're going to want to see the broader numbers, those aggregate numbers, starting to move.
It sounds like, Betsy, I have heard some folks kind of question, they see these headlines, Betsy, about these tech layoffs, and they do wonder whether that's a kind of tell, is that a kind of canary in the coal mine for the broader labor market? It doesn't sound, though, like you see it that way.
For sure, there are people who are like, is this the canary in the coal mine? Should we be looking at this as, more to come? those initial unemployment insurance claims, they come out every week. So we're not lagging behind in that data. What we saw during the pandemic was the tech sector hired more than anyone else. They really got ahead of their skis. We've already been through, one round of, whoa, the tech sector is laying a bunch of people off. What does this mean for the broader economy? Turned out it meant nothing bad for the broader economy. It meant a healing economy, which was reallocating people away from a bloated tech sector towards sectors that were struggling to hire people who were in demand. I think that's the open question right now. There's still a lot of hiring out there. It's obviously not as booming of a labor market as it was, a year and a half ago. But the question will be, is this tech sector, a canary in the coal mine, or is this more reallocation to places where we need people more than we need them in the tech sector? I think we do still have a healing economy, so I feel very confident that people are going to be reabsorbed into other parts of the labor market. But there is a difference right now. We are in a normalizing, slowing labor market. And for certain people who are experiencing layoffs are not going to find it as easy to get a job that is as well paying or as good as what they had before. And that's going to mean people are feeling some pain.
Betsy, you wrote recently about the continuing challenge in predicting economic growth and the trajectory, right? And I guess we got another example of that today with the PCE and spending data. And as I was detailing earlier in the show, some of the economists' notes I saw in reaction were almost giddy with, the consumer is still spending. So how do you get your arms around that now as we head into 2024?
What I love about the data right now is it's a reminder that it's people and it's people's choices that drive our economy. The economy is not some magical third-party thing that does its own thing and we just have to live with it. It's actually what we're looking for is just what's the collection of people in our economy doing. And, the other data that came out was data that said, from JP Morgan showing that people actually do still have more money in their bank accounts than they had prior to the pandemic. I think we have learned a really important lesson that it's not, a small set of job creators where if we give them a bunch of tax cuts, the economy is going to boom. No, it's actually all of us. And when we support people through difficult times, when people are able to continue spending, even as they go through a difficult time, when they built up enough of a nest egg where they have access to credit, we see that that's what actually keeps the economy going. And in fact, what I think is getting not enough attention and airtime is really the record amount of new business formation that we've seen in the US economy. That's not coming from big corporations. That's coming from everyday people deciding they're going to take a chance at starting their own business. That's been one of the big drivers of this current economy. And one of the things that I think has been really hard for people to predict. People have been studying new business formation for decades, have said they didn't see this surge in new business formation coming. Why? Because I think we don't really deeply understand what it takes in the psyche of someone to start a new business. And what we're learning is clearly one of the things it takes is knowing you'll still be able to feed your family.
As you say, it comes back to the humans. And thank you very much, Betsy Stevenson, for joining us and your perspective. Appreciate it. Coming up, crude oil posting its biggest weekly jump since October. We'll look at the state of play in the commodity space and LNG as well, straight ahead.
The Biden administration announcing changes to natural gas exports, essentially freezing them in the near term, saying it needs time to better understand the long-term climate impacts of shipments. Activists cheering that move, but it's raising concerns about the U.S. status as the world's largest exporter of liquefied natural gas. And joining us now is Andrew Lippow, president of Lippow Oil Associates. Andrew, it is good to have you here, and I want to actually start, Andrew, on that headline, this decision of the Biden administration to pause approval, Andrew, of LNG exports. And Biden is talking tough here. He says this pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time. So listen, big headline here, Andrew, but really kind of bottom line this for us. What does this actually mean, Andrew? What kind of impact does this actually have?
Well, thanks very much for having me. In the near term, the impact is very limited. We actually have 3 large LNG export facilities that are coming on stream in the next 12 to 18 months on the Gulf Coast, which will make the U.S. an even bigger LNG exporter. What these new rules do is delay these several projects that were underway looking for their final permits so they could go ahead with the construction, but those plants wouldn't be coming on stream until 2027 or beyond. I think in the context of world energy supply, we have Russia's invasion of the Ukraine resulted in Europe really eliminating the majority of its natural gas imports from Russia. They've been turning to the United States and other suppliers to fill in that gap. And that's where I see the biggest issue going forward.
Hey, Andy, it's Julie here. Are we going to see some of the LNG producers and exporters in the U.S., are there any kind of measures they can take to, say, offset emissions that then would satisfy the administration?
Well, I think one of the biggest things that producers look at here in the United States is this carbon capture and sequestration, meaning that as they produce the oil, especially if the natural gas is being burnt off into the atmosphere, to put that back and re-inject it into the ground, or any of their carbon dioxide emissions need to be re-injected into the ground to lower what we call their carbon intensity.
And Andrew, I want to switch gears a bit. Let's talk about oil. I'm looking at Brent here at 78. Where do you see that price headed, Andrew, in kind of just the near to intermediate term here?
Well, today we had an event in the Red Sea where a missile struck an oil tanker that was on its way from the Mediterranean to Singapore, and that caused the oil market to completely turn around. We were down $1 this morning. We're up about 70 cents this afternoon. And these geopolitical tensions in the Middle East are causing the oil market to price in a higher probability of a supply disruption. So as a result, I'm expecting that we could see $80 WTI here in the next couple of weeks. And that, of course, translates into higher gasoline and diesel prices for the consumer.
And watching the headlines on that strike, by the way, it was a Trafigura oil tanker that apparently was struck. The one that was struck was carrying Russian fuel specifically. Andy, what are you watching? How are you even, obviously it's a very unpredictable situation, but how do you sort of game out the effect on oil prices and how sustained the effect is going to be?
Well, what I would say is these missile attacks on shipping are really disrupting the supply chains. They haven't caused any oil production to be shut in. What I expect is that these tankers are now going to be avoiding the Red Sea pretty much altogether and taking longer routes around the Cape of Good Hope, which adds about 2 weeks transit time. That, of course, adds to the cost. We also see that a number of ships that are transiting through the Red Sea that are carrying Russian oil or maybe Russian-owned, now in their satellite information are saying that they have no ties to Israel in order to avoid attacks from the Houthis. Unfortunately, the Houthis may not have the most up-to-date information of who owns which tankers, and they may actually end up attacking and sending a missile to an oil tanker that's owned by the Russians or someone else, maybe even the Chinese.
Andrew, I want to get you out of here on this. You know, another big theme for investors in the energy sector is just the amount of deal making we've been seeing, Andrew. You know, it's Exxon, Chevron, everybody's making moves. One, do you see that kind of activity continuing here in 2024, Andrew? And two, any companies that you would see as possible acquisition targets?
Well, I think the consolidation in the Permian Basin is going to continue because many of these companies have felt it's just simply easier to buy a company and buy their reserves than for oil in an uncertain environment, especially overseas. I mean, one name that comes to mind is Diamondback Energy. You know, they're a big producer in the Permian Basin. We could see more consolidation on the natural gas side as well. We just had Southwestern Gas, merge with another company in the Permian. We could also see these consolidations extend to even smaller producers that are operating in Colorado, Wyoming, or North Dakota.
It's a big, important theme. We're going to keep watching. Andrew, thank you so much for joining us today.
Thanks for having me.
Coming up, we're going around the horn to check in on some of today's top trending stories. Alec Now, Josh Schaefer, and Brooke DePalma are out on the newsroom floor with what to watch.
Hey, Josh. Well, on the other side of this break, we're going to be taking a closer look at the latest layoffs from media giants such as Disney, Paramount, and even YouTube.
And the reviews are in for McDonald's latest spin-off franchise, Cosmix. But will it help jack up profits?
And speaking of getting jacked up, Monster Energy is the latest from the drink industry making the jump in alcoholic beverages. We've got the details on that when Yahoo Finance returns.
Hello and welcome to Yahoo Finance's group chat. I'm Alexandra Canal here with Brooke DePalma, Josh Schaefer. And today, guys, we're starting on a bit of a somber note. We're talking layoffs of some pretty heavy hitters in the entertainment industry, from traditional media like Paramount Global to some of those publications and newspapers like Sports Illustrated and the LA Times are going through layoffs, or at least some of these companies hinting that layoffs are going to be coming down the pipeline. And it seems like the reckoning that we saw really throughout 2023 is continuing in 2024. Across the board, a lot of these companies have been trying to right-size their businesses, trying to reduce headcount, reduce the amount of money that they're spending, because at the end of the day, streaming is not still profitable. You have the advertising environment that is just not getting better. That's hammering these cable companies. And the background of that, you have M&A chatter, so there's a lot of offloading and divesting those non-core assets. And I just wonder what this means as we head deeper into 2024 and really what the future of the industry looks like, because it's certainly going through a big shift.
The ad market comment's interesting because you think about a company like Netflix who has had better margins, and part of what they were able to do was add that ad tier, right? Some of these companies don't fully have that option because they already rely on advertisements a significant amount. I'm thinking of YouTube and I'm thinking of Paramount. They already have arms that build off ads. So it's sort of, where else can you cut costs because you can't maybe get top line higher, and it comes down to headcount at some point. The other thing, Brooke, is just a lot of these companies are paying a lot for content, right? At some point, if you're paying $1 billion to get NFL Sunday Ticket, you're gonna probably need to cut costs somewhere else, and you probably need Sunday Ticket to get people on the platform. So I get the spend, but obviously that comes with a cost somewhere else.
Yeah, and it seems like that's exactly the narrative across not just the media industry, but really across multiple different sectors. We're talking retail industry like Levi's, tech industry like Salesforce. We're also looking at Microsoft, Wayfair. It's really this reallocation of resources that we're seeing, where they're really prioritizing where the future of the business is going and where employees, different needs, different desires, different skill sets are really needed. And we saw that most recently, like I said, with Levi's, with Microsoft. They did let go, or hint towards letting go, 1,900 Activision, Blizzard, and Xbox employees, really as M&A happens, as they're really looking where they need that skill set. And, you know, it seems like that's going to be a common theme in 2024 as well.
I think, and when you zoom out, think about how quickly we hired after the pandemic, right? You lose, I think it was about 20 million jobs in April 2020 in 1 month alone. And then you have to sort of rehire a lot of these people, not necessarily that they work for the specific companies that were mentioned, but the labor force as a whole, right? And when you're doing that rush to hire, you're overpaying probably, you're trying to train talent quickly, and then I think you pick your head up 2 or 3 years later and you go, okay, who we hire? Who we hire? What divisions did we create? And can AI take some of those jobs or help make them more efficient? There's just a lot of things at play here.
And also, does it apply to the future of what people are trying to task? And that includes McDonald's. It was a rumor, then it was made a reality, and now it's been tried and tested. I'm talking about McDonald's, its latest spin-off franchise. It's called Cosmics. Now, the reviews are in, but as fast food aims to sit out the storm on high rates, will this prove a success? So for those of you who don't know it, it is a smaller format drive-through beverage and snacks concept. It's largely trying to pick up that 3 p.m. slump, so being drive-through only, it lends the opportunity to get smaller bites. And according to Placer.ai, it is seeing some good results here. It's seen double the number of visits than a typical McDonald's saw chain-wide during December 2023. And what Josh and I were talking about was, this is a new concept. Of course, people were really excited about it, but it is an exceptionally great on margins business, given that it is beverage, it's snacks, and you can't help but think of competition like Dutch Bros, who did say that they have learned from Starbucks being in backyard. They're not intimidated by this new McDonald's concept, but consumers seem to be excited here.
Yeah, it's interesting. It's leaning in on the coffee aspect of it all, because people love McDonald's coffee. I mean, it's something that people talk about.
McCafe is solid.
Right, and you're like the coffee expert,
that's
so
a solid,
I trust your
That's a solid
opinion.
cup of iced coffee.
Yeah, and it does make sense to me, also catering to younger types of consumers on the go. I think a lot of people are returning to work again. Where can I go to get a quick bite, just to drive through, grab it, go back to the office or go back home? So you said, though, right, that 4-hour lines or something.
Yeah, 4-hour long lines
For
at
a
the
quick
open.
service
I mean, there's no chance
restaurant.
I'm waiting.
No
Yeah,
way.
there's no chance I'm
4
waiting.
hours for a coffee?
4 hours for
thank
coffee.
you.
I don't know what the lines are like right now, but it is young people who are looking to go there. It tends to
I
skew
mean,
between
it's
18 to
Illinois though,
34.
too. There's great fast food competition out there.
Great fast
Like
food.
Culver's
Wendy's,
always has a line,
breakfast.
Portillo's always has a line, but I'm waiting those lines before you get cake shake, right?
Yeah. No,
I don't know what any of that meant. I've never really been to the
food.
Midwest.
Also a fast food dining, yeah.
Yeah.
But when you really
to
think about
visit.
it too, the breakfast day part is coming back a bit for McDonald's, and their earnings are coming out February 5th. And what a lot of analysts are leading to believe us is that this is a resilient stock. This keeps coming back. We saw it bounce back from the GLP-1 craze. We saw it continue to remain resilient during COVID. And really here, what many expect is continued sales growth, continued momentum here in the U.S., despite higher prices and despite all this other outside noise.
All right, Brooke. We got to lighten the mood after the analyst talk. We got to lighten the mood. It's Friday. It's almost 5 o'clock. I want to talk about some boozy beverages. We've had some brands like White Claw have been jumping on the sober curious bandwagon, and now we've got others doing the reverse. So Monster launching a hard tea, the Nasty Beast.
Oh my God.
You can get this in the original
The
flavor.
Nasty Beast.
It comes in tea plus lemonade, so basically like an Arnold Palmer flavor there, or green tea. It's got 6% alcohol by volume. It's not a energy drink like you would expect from Monster in the sense that
It's
it's
not
very,
an energy drink.
that it's very high caffeine content. No.
It doesn't
But it
have,
does have caffeine?
I think it has some,
Well, I guess
but it doesn't.
tea, it does have
but it doesn't
caffeine.
have like Monster level caffeine. That's
Okay.
not the
I
picture.
I wonder how
to know
that's going
there.
to work, because I feel like Monster is just known as being an energy brand.
Yeah.
So how can you tell people that there's not, like immediately when I thought of this, I thought of Four Loko, and I thought of those types of drinks. I was like, haven't we learned? Haven't we gotten past this? This can't be good for you. But that's interesting to hear that it's not.
So Monster
necessarily
launched an
energy drink.
alcoholic beverage actually last year, and it did $87 million in sales. And so their management is saying that they want to build off of that and sort of build a brand around it and add new drinks to it.
But this is something to watch in 2024, this concept of a hard tea. Another brand that many are watching out for is called Surfside.
I love Surfside.
It's up and coming. It's a similar hard tea concept. And Bump Williams Consulting, he told me to watch out for that. He said that's one thing to note there. But really, we're seeing so many mainstream players like Coca-Cola and Jack really get in this game of conceptualizing these bigger convenience plays. We know that people mix Jack and Coke all the time, so they made a can out of it. And really what Monster is trying to look is get in on that trend of people looking for convenience on the go and some booze that's all ready to,
I'm old
to
school.
consume.
I'm old school.
You like to mix?
Yeah, you got to put
He's
the
a
Jack
mixer.
in the Coke yourself. Like
Okay.
that's part of the fun. Every mixologist,
Part of the
I
fun.
think every mixologist thinks that they make it the best,
Are you,
right?
are you calling yourself
I'm
a mixologist?
We're all mixologists on a Friday at 5, right?
Yeah, that's true.
For me.
I agree with that take.
We got to go do that, right? We got to go take a look at that. So coming up, we are going to bring you what to watch next week. We break down the stories you need to know.
Pensions are back. Sort of. IBM is saying goodbye to its 401k. Instead, employees will now have access to a plan reminiscent of an old school pension. Here to break down the details is Yahoo Finance's Carrie Hannon. Carrie.
Well, yeah, this has sort of had the retirement industry a buzz for a while now. And starting in January, IBM kicked off this new option. Now, it's not getting rid of their 401k, but what they are doing is instead of the employer match to the 5% employer match, they're taking that 5% and putting it into what's like a cash balance account. And so you can continue to contribute to a 401k if you're already there. But what this benefit does is that it allows you, they're going to take that 5% if you've been there for a year. They'll take 5% of your salary, put it in this account, and you don't have to make any investment decisions. And when you choose to leave, you can take it with you. It's portable. You can take a lump sum, or you can have it moved into an annuity that will pay you out a benefit for the rest of your life. This is kind of a really interesting option to shift back to. They're guaranteeing, I think, for the first 3 years, the 6% return, and then it will be tied to the 10-year Treasury. But what's interesting is it's trying to solve a problem where people are panicked about will they outlive their money, and they yearn for those days of pensions where only about 11% of private employers plans have a pension option, but they want somebody that they know they're going to have some kind of income stream. So this is kind of a big deal in the industry. I don't know how much more of this we're going to see, but I do think it's a movement to pay attention to people who have that inertia about starting to save for retirement. And more retirees than ever more individuals are turning 65 this year than ever before in history. So we're going to see more people retiring. And these kinds of lifetime annuities perhaps will be a version of this. But guaranteed income is starting to edge back into the retirement scenario. So stay tuned.
All right, we will. Carrie, thank you so much for that. Enjoy the weekend. Time now for what to watch next week, which could be make or break for the markets. On the earnings front, a huge week for big tech. Microsoft, Alphabet, Apple, Amazon, and Meta all reporting results. Alphabet and Microsoft earnings coming out on Tuesday. As for Microsoft, it comes after announcing layoffs in its gaming division. Apple is reporting on Thursday, trying to reassure investors after a shaky start to the year.
Moving on to the Fed. The Federal Reserve's next meeting starts Tuesday with a rate decision on Wednesday. Now, the market's not expecting any kind of rate cut this month, but still looking toward March for the first rate cut of the year.
And over to the job market, a new JOLTS report for last month from the Bureau of Labor Statistics is out on Tuesday. Job openings taking a dip in November and expecting to drop again in December.
And we'll get the monthly jobs report on Friday. The economy expected to have added 178,000 jobs in January. That would be a decline from December. The unemployment rate expected to tick higher to 3.8%.
Julie, we've got a very busy week next week.
We do.
We do. We got some big tech earnings on deck. Very interested in Apple. Reports on February 1st. Stock is basically flat so far this year. Big questions for Apple investors. How healthy is that iPhone franchise, especially in China, where the economy is weak? You got competition from local rivals like Huawei. What does non-iPhone hardware look like? The watch we know has been making headlines. And of course, services, faster growing, higher margin business. I think investors want to know, does that kind of remain a real growth driver here?
Yeah, there's so many things to choose from. But I thought we had an interesting conversation with Angelo Zeno earlier where he hit on a lot of the tech names. And in Microsoft's case in particular, he talked about three secular growth drivers for the company: cloud, AI, and gaming. Of course, they're just acquiring Activision. And so he seemed pretty optimistic about those three growth drivers. It'll be interesting to see any color we get on things like Copilot, which of course is generative AI powered, and how all of those new Gen AI tools are actually going to flow through to the bottom line. That seems to be what investors want to know for Microsoft. So
for sure. I mean, you look at that stock, so much excitement about how they've been integrating AI across the product portfolio, Bing, Azure, Copilot. So totally agree, that'll be in focus.
Yes, it will. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back on Monday, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. Have a great weekend.